Okay, so have you ever bought a stock, like, because everyone's talking about it and it's like the hot thing, and like the next week it just totally tanks? Or like
Yeah.
when the market dips and you like just want to sell everything before you lose it all?
Right. You're describing the very core of behavioral finance,
Oh, okay.
which is how our emotions often kind of hijack our best financial plans. It can happen to like even the most seasoned investors. It's surprisingly common, actually.
So today we are diving into the emotional side of investing, and we are using The Behavior Gap by Carl Richards as like our guide for this deep dive.
Great
We're
book.
going to unpack some of those common emotional pitfalls and hopefully give everyone listening some tools to actually like overcome them.
Hmm. What I find really interesting is Richards highlights three emotions in particular: fear, overconfidence, and then that tendency we have to blindly trust others. Maybe we can break those down a little bit.
Okay, yeah. Let's do it. Let's start with fear. I'm guessing this is a little more than just being afraid of spreadsheets, right?
Right. Think about that age-old advice: buy low, sell high. Sounds pretty straightforward, right?
Yeah.
But fear often makes us do the exact opposite.
Oh, yeah.
When markets take a tumble and we see all those numbers in red, our gut reaction is to sell, 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 even if it means, taking a
It's
loss.
like that just get me off this roller coaster feeling.
Exactly. And then on the flip side, when the market is soaring and everyone's feeling, invincible,
Yeah.
greed takes over. We buy in at those like really high prices because we're terrified of missing out. And what happens? Often we end up riding that bubble right back down.
So it's like our emotions are kind of tricking us into doing the opposite of what logically we should be doing.
Yeah, that's what's kind of insidious about fear and greed. They just completely cloud our judgment and make us act so impulsively.
Okay. Clouded judgment, speaking of. Let's talk about overconfidence. I think we all kind of secretly believe we can, like, beat the market, right?
Maybe more than we'd like to admit. Richards tells this really cautionary tale in his book about long-term capital management. It was a hedge fund run by, get this, Nobel Prize-winning economists.
Wow.
They were at the very top of their game,
Yeah.
but their fund still managed to go belly up.
Wow. If Nobel Prize winners can't figure it out, what hope is there for the rest of us?
Right. It's like this humbling reminder that um, no one can really predict the market,
Yeah.
which actually leads us to that third emotional pitfall: blindly trusting others.
Oh, yeah. This one I get, like, when you're talking to, like, a family member and they give you a hot stock tip.
Exactly.
Yeah.
Or even, those financial news segments that
Yeah.
make every market move seem like this massive life-altering event.
Ah,
We just kind of assume these sources must know more than we do.
yeah.
But usually it's just a bunch of noise.
Yeah.
And it distracts us from, our own personal financial goals.
Which reminds me of that story that Carl Richards tells
Uh,
about how he invested in tech stocks back in '99 because his wife's brother gave him this like insider tip,
oh, no.
and it did not end well.
Yeah, that's the thing about blindly following the crowd or
Yeah.
thinking that someone else's advice is going to be right for you. Richards learned the hard way that uh, even well-meaning tips, they can really backfire if they don't sort of line up with your own risk tolerance and your own personal goals.
So how do we actually tame this inner financial foe? I mean, these emotions, the fear, the greed, like the urge to just follow everybody else, it feels like it's so ingrained.
It's powerful stuff.
Hmm.
But Richards offers some really great strategies
Okay.
for creating a personalized, financial game plan, and one that really acknowledges these emotional biases and helps you work through them in a better way.
Okay, so what's the first step? How do we get our emotions to work for us and not against us?
Well, he says it all starts by um, understanding your why,
Okay.
like your real motivations behind your finances, your money. So, for example, are you saving up for like a down payment on a house?
Yeah.
Is it your dream retirement? Do you want to start a business? Travel the world.
It's interesting you say that, focusing on the why. Because, I mean, achieving a diversified portfolio, it
Mhm.
just doesn't have that same kind of like emotional pull as like, buying a beach house.
Exactly.
Yeah.
I mean, when you can actually connect your financial goals with something tangible, something meaningful to you personally,
Yeah.
it becomes way easier to actually make rational decisions
Right.
and resist those like
Yeah.
impulsive urges that can completely derail you.
Yeah, it's like having this vision board of your dream life. But instead of having, pictures from a magazine, you've got like, your budget spreadsheet and like your investment portfolio.
Right. I like that. It's about aligning your choices with your values, your aspirations.
Okay. So we've got the why figured out. Now what? Like how do we actually start putting a plan into action?
Well, Richards has this really it's interesting. He calls it sleeping on it.
Hmm.
And I think it really applies here.
Yeah, like my grandma used to always say, don't make a big decision on an empty stomach
There you go.
or right before bed. So I guess my grandma was like a behavioral finance guru.
That's right.
Yeah.
It's it sounds like common sense, but when we're caught up in a moment,
Oh, yeah.
whether it's that fear or that excitement or like the everybody's doing it kind of energy,
Right.
we tend to make those rash financial moves that we end up regretting.
So are you saying like when we're about to make like a big financial decision, like buying a stock, selling an investment, or even some like buying that, new gadget.
Yeah.
We should like hit the pause button for a minute and just like really think it through.
Yeah. Even just a few hours, maybe even just a night's sleep.
Yeah.
It allows the rational part of your brain to catch up with all those emotional impulses.
That makes sense. So, okay, those are big decisions. But what about those like smaller ones, those everyday financial choices that like over time kind of add up?
Well, I think one of the most like powerful ideas that he talks about is shifting your focus. Instead of like going for the highest returns, going for what he calls acceptable returns.
Acceptable returns. I like the sound of that. It doesn't sound as intense. Tell me more.
Yeah, it's about finding a rate of return that works for you
Okay.
and your financial goals and your risk tolerance without always chasing the next big thing.
So instead of always trying to get those like, the biggest returns possible and taking on all this risk, we figure out what like a reasonable rate of return would be and we make our decisions based on that.
Yeah, it's really about finding that sweet spot where you feel good about the amount of risk that you're taking and the potential reward. And remember, it's your money, it's your journey. You get to decide what success actually looks like.
I like that. That takes the pressure off, right? Like you don't have to beat the market. You just have to reach your goals.
Yeah.
But how does diversification fit into all of this?
So diversification is really the key to managing risk. It's kind of like, that saying, don't put all your eggs in one basket.
Well-
You're spreading your investments across different types of assets, different industries, different parts of the world even.
So that even if like, one of your investments isn't doing so hot, the others can kind of like balance things out.
Exactly.
Yeah.
Exactly. It creates a more resilient portfolio, one that can handle those ups and downs that are bound to happen in the market.
This reminds me of that story that Carl Richards tells about how he realized he had way too many snowboards.
Oh, yeah.
He was like so worried about having the absolute best snowboard for every single condition that he just got totally overwhelmed.
Yeah. And that happens in finance, too. It's like sometimes good enough is actually better than holding out for some like perfect ideal situation.
Yeah.
Trying to time the market perfectly, picking all the winning stocks, finding that one magical investment strategy.
It's impossible.
It's a recipe for disaster and usually disappointment.
Yeah. So you have to find that balance between being, informed and making smart moves, but also accepting that we're not going to be right all the time.
Exactly. And that leads us to, I think, a really important part of this whole thing, which is, staying the course, even when things get a little rocky.
Because, yeah, like staying calm and rational when the market's going crazy is, it's a lot easier said than done.
It is. But having a really strong sense of your why, like what we were talking about earlier, remembering those goals, those personal financial goals,
Right.
that can make all the difference. It's about remembering what you're working towards and why it matters to you.
It's like having that vision board again, like that picture of, you finally retire early or your kids are, graduating college.
Right.
Debt-free.
Connect those goals to something real,
Uh-huh.
something that makes you feel good and reminds you why you're doing this whole thing in the first place.
And be kind to yourself along the way. Like, it's okay if you have to adjust your plan a little bit or, rethink your goals. Or, like, if you need to talk to a financial advisor, that's okay too. It's about progress, not perfection.
Right. Couldn't have said it better myself.
Mhm.
Approaching your finances with curiosity, with flexibility,
Yeah.
being open to learning new things. That's what it's all about.
This deep dive has been so interesting. I feel like we've learned so much about all those emotional traps that we can fall into when we're investing, the importance of understanding our own personal, financial goals
Oh.
and focusing on what we can control, like our own choices.
And we've talked about some really practical tips that you can start using today, like that sleeping on it technique, aiming for those acceptable returns, making sure you're diversified, and remembering your why.
So as we wrap up, here's something to think about. What's one part of your finances that feels like really driven by emotion right now? Maybe it's checking your investment portfolio like every 5 minutes, or that feeling you get after you like buy something that you maybe shouldn't have. What's one small change that you can make today to bring a little more logic into that part of your financial life?
Remember, even those small changes can make a big difference over time.
That's it for this deep dive. Thanks for listening, everybody.